Many investors are leaving money on the table by misunderstanding the true nature of dividend and growth stocks. So in this video, my AI assistant Tiara and I will break down their key differences, help you make the right choice for your own financial goals, and uncover some mind-boggling long-term performance data that will completely shift how you view each of these options. So Tiara, how should we start this one out?
Let's compare dividend and growth stocks directly.
Okay, yeah. So when we're talking about dividend and growth stocks, we're really looking at two different game plans in the investing world. So dividend stocks are like those, steady, reliable friends who always chip in for their pizza. They're usually mature companies that have been around the block, right? They're companies like Coca-Cola or Johnson & Johnson. These guys are all about sharing their wealth, and they give shareholders a slice of the profits through regular payments. Now, growth stocks, they're more like that friend with the big dreams who's always reinvesting in their startup. Think of Amazon in the early days, especially when they were starting to build out their own warehouses nationwide. These companies are all about expansion, right? They're pouring their profits back into the business to fuel growth. Now, later in the video, I'll share some simple advice to help you make the right choice for your own unique investment goals, ensuring that you're, not leaving money on the table as an investor. But here's one of the biggest differences. With dividend stocks, you're getting cash in your pocket regularly, regardless of the stock price. But growth stocks, well, those companies are playing the long game, right? You won't see a dime with these until you decide to sell, but the potential for bigger gains down the road could actually be massive. Now, it's not just about the money, though. The goals of these companies are very different as well. So dividend payers are all about stability and consistent earnings. Growth companies, they're really the risk takers. They're often prioritizing expansion over immediate profits. And this difference, it attracts different types of investors too. So if you're nearing retirement or just love the idea of regular income, dividend stocks, they might be perfect. But if you're cool with more risk and have time on your side, growth stocks could be the way to go instead. Interestingly, they also react different during extreme market changes. So when the market goes crazy, dividend stocks often act like a cushion, kind of softening the blow. Growth stocks, well, they will be a crazier ride, but hey, with greater risk comes the potential for greater reward, right? Now, just remember, these are generalizations, and the stock market, it isn't that black and white. Kind of like how finance isn't black and white either, which is why you should take a second to subscribe to the channel and continue learning complex financial topics in a way that's simple to understand, which is what I try to do. But while dividend and growth stocks generally act as I just mentioned, there are always exceptions to the rules. And of course, stocks can always lose a ton of value depending on many other variables. All right, Tiara, we're done with the overall comparison here. So what's next?
Let's get into risk and volatility.
Perfect. We can do that. So generally speaking, dividend stocks are pretty chill. They're kind of like Keanu Reeves, right? Studies show that they're usually about 12% less volatile than their non-dividend paying pals. When the market gets bumpy, these stocks tend to kind of smooth out the ride. Now, growth stocks, they're more hyped up. So you could think of like Steve-O in the early 2000s from Jackass.
3.
So basically, they might make you rich, or they might make you regret every life decision while metaphorically getting hit in the face with a shovel.
Yeah, Tiara, actually, kind of like that. In fact, historically, they've had about a 34% bigger price swing compared to dividend stocks, so they really aren't for the faint of heart. But let's look further at how these two behave in different market conditions. So during bull markets, which is when everyone's optimistic and stocks are generally going up, growth stocks often crush it. So in 2021, for example, they were dominating with gains of around 38%, while dividend stocks, they were, at about 15%. But when the bear market comes around, which is when stocks are falling for the most part, well, boy, did the tables turn. So in 2022, dividend stocks, they only had a slight stumble right at about 3%. But growth stocks, they took a nosedive, plummeting at about 29%. But hey, don't think that dividend stocks are a no-lose proposition, right? They've got their own risks, and one of the main ones is being a dividend trap. So this happens when a stock has a super high yield, but it's actually a red flag, and they end up cutting the dividend or, completely or reducing it quite a bit. AT&T did this in 2022, and it resulted in a dividend cut after 35 years of increases. And as you can imagine, the market obviously didn't react very favorably to that. Now, growth stocks, they have their own bag of tricks too. So they're often priced for absolute perfection from the company. And if those companies don't meet those sky-high expectations, well, it gets a little bit ugly. All right, so Tiara, calling on you again here. What's the next section?
How about long-term performance analysis?
It should be quite interesting if you aren't familiar with the data behind all this, right? And stick with me here too, because while I still plan to share the advice that I had mentioned in the intro to help you make the right choice for your own investments, this long-term analysis is really going to teach you some surprising stats. So first off, let's look at the big picture. Historically, dividend-paying stocks have been the unsung heroes of the market. In fact, did you know that between 1930 and 2023, a whopping 40% of the S&P 500's total return came from dividends? That's right. Nearly half of the market's gains were from those regular payouts. Now, let's talk about the power of dividend reinvestment. So imagine that you had invested $100,000 in a fund tracking the S&P 500 back in 1990. Well, if you just let that sit there, by the end of 2022, you'd have had about $1.1 million. Not bad, right? But here's the kicker. If you had reinvested those dividends, that same $100,000 would have grown to $2.1 million. But what about growth stocks? Well, they've had their moments in the sun too. So during bull markets, growth stocks outshine their dividend-paying counterparts, usually by a long shot. So for example, in 2021, growth stocks had gains of around 39%. But let's talk about the best of the best, which is really dividend growth stocks. And yes, they do exist, and they are typically overachievers on the stock market. So according to a study by Ned Davis Research, dividend growers and initiators delivered total returns of 10.19% per year from 1973 to 2023. That's better than the equal weighted S&P 500's performance of 7.72% per year. Now, it might not sound like much, but over time, that difference is huge. But the interesting thing about that is that dividend growth stocks achieve this outperformance with less volatility as well. All right, so Tiara, what else should we consider here?
Tax implications, because Uncle Sam needs them dollar bills.
Yeah, Uncle Sam sure does. All right, let's talk taxes because, well, it's something that we all have to consider as a trader, right? So first up, dividends. So they come in two different flavors, right? There's ordinary dividends and qualified dividends. Ordinary dividends are like regular income. They're taxed anywhere from 10 to 37% depending on your tax bracket. But qualified dividends, well, they get some special treatment from the IRS. They're taxed at either 0, 15%, or 20%, the same as long-term capital gains. And here's a fun fact about the difference. If you're single and you're making $60,000, your qualified dividends get hit with a 15% tax. But if you're married and pulling in $90,000 together, those same dividends are actually tax-free. So the tax code details why that is, but there can be a stark difference between the two. Now let's chat about capital gains. So if you're flipping growth stocks often, meaning that you're holding them for less than a year, you're looking at short-term rates, which is usually up to 37%. But if you play the long game and hold for over a year, you're back to those sweet, 0, 15, or 20% rates. So now that we have taxes figured out, kinda, where to next here, Tiara?
What about helping them make the right investment choice?
Okay, yeah, perfect, I can do that. And as always, not financial advice, but let me give you my take. So when it comes to choosing between dividend and growth stocks, it's all about aligning your picks with your personal financial objectives. So first things first, let's talk about your financial goals. So are you looking for a steady stream of income, like a paycheck from your investments? Or are you more interested in, watching your money grow over time? Your answer to this one question is going to be a big factor in deciding between dividend and growth stocks. Generally speaking, if you're eyeing that, regular income, then dividend stocks really might be your best bet. Now, on the flip side of that, if you're all about that long-term wealth building and really don't need the cash right now, growth stocks might be more your speed. But let's talk about your time horizon too. So are you planning for the next year or the next decade?
Or are you planning for the day after next? Because impulse buying crypto sounded like a great idea at 2 a.m.
Okay, Tiara, crypto it's just a whole other discussion that we're not going to get into here today. Anyway, if you're playing the long game, right, growth stocks, they might be a good fit, right? They can be more volatile in the short term, but over time, they have the potential for significant gains. And risk tolerance is another big factor to consider as well. So how well do you sleep at night when the market's just going crazy? If market swings, they make you nervous, dividend stocks, they might help you rest easier. However, if you're comfortable with more risk and can really hold through the market ups and downs, then growth stocks could potentially offer higher returns in the long run. And don't forget about the taxes. Now, we just went over a little bit, but dividend income is taxed differently from capital gains, from selling growth stocks. So depending on your tax bracket and how long you actually hold your stocks, it could make a big difference in your overall returns. And remember that there's really no one-size-fits-all answer here. The best choice really depends on your unique financial situation, your goals, and your comfort level with risk. It's kind of like choosing between a steady job with a paycheck and, starting a business. Both of them can lead to financial success, but the journey is going to look very different. Now, my thoughts, well, as everything else on this channel, like I mentioned, this isn't financial advice, but you don't have to choose just one investment strategy. Many successful investors, including myself, we will mix both dividend and growth stocks in our portfolios. And I'm also radically transparent about my investment. And if you want to see exactly how I invest my money and what AI had to say about it, you can click right up here for this video. Or if that video doesn't seem too interesting, go ahead and check out this other video instead. But before you go, please make sure to subscribe to unlock financial success one AI chat at a time.